PC Net Services, a service-disabled, veteran-owned small business connecting you to the world.
Get better cell service in your building, no matter which carrier. For a free analysis, call PC Net Services, 815-545-4439, 815-545-4439. This hourly segment is brought to you by the Money Hour radio show, Saturday afternoons at 3 on AM 560, The Answer. Brought to you by Pearshell Financial Group.
6:37 this morning. Team Hochberg Traffic Center time and Jim.
On the Kennedy and Ryan expressways, ramp closures are expected to kick in the next half hour or so in the downtown area. Currently, the ramps are open, but downtown area access is again restricted, essentially from Division South to 26th and from the Lake West to Olmsted, except for essential workers and residents. Blockages are in place. Lakeshore Drive is closed northbound from the Stevenson up to the downtown area. The ramp from the inbound Stevenson to northbound Lakeshore Drive is blocked as well. We're seeing mild congestion on the inbound Stevenson and inbound Ryan. There's also congestion in Aurora on the eastbound Reagan Tollway from the Aurora Toll Plaza to Farnsworth. It's traffic. I'm Jim Talamonte on AM 560 The Answer.
Chicago's Morning Answer continues next. In our 1 hour heating and air conditioning weather center, sunshine. Temperatures may bust through the old record of 92 set back in 1944. Cloudy, breezy, then showers and maybe a heavy thunderstorm overnight, low 73. The worst of the storms projected to be across the Wisconsin state line. We have a slight risk here. 68 at O'Hare. Next news at 7. Chicago's Morning Answer with Dan and Amy continues next on AM 560, The Answer.
Listen to AM 560, The Answer, online at 560theanswer.com, on the AM 560 mobile app, on your Alexa-powered smart speaker, on TuneIn, iHeart, and radio.com. Only the biggest stories, only the biggest guests, and only the biggest opinions. This is AM 560, The Answer.
Top of the morning, Dan and Amy, and as I mentioned, it's always useful to have a real-world example to explain a economic concept or fallacy.
Yes.
But this is taking it a little far to offer a dissertation on Bastiat's broken windows fallacy. We'll start there with Jim Iuorio, CNBC contributor. Jim, thanks for joining us. Appreciate it.
Thank you for having me.
You know what I'm talking about, don't you, Jim?
I do.
Yes,
yeah.
I figured you might. That joke was just for you and me and no one else.
No, this is very inside baseball.
Right, exactly.
So why don't we start with the markets? Is there anything short of nuclear winter that can occur that will stop the ascent of the market?
It doesn't seem so. This is really weird, but we got to keep it in perspective and remember what the drivers are. And it's not coincidental that this rally began on March 23rd. That was the day that the Fed announced unlimited quantitative easing. So the Fed and the federal government both kind of in unison said, we will throw whatever we need to throw at, let's say, the economy, but in my mind, I think it's risk asset prices as well, to keep them buoyed and keep them rallying higher. And that's what we've seen. Now, I'm not saying for people who want to throw stones at me, I'm not saying that's the only reason. I'm saying that the lows we saw in March were pulling a lot of economic destruction forward and pricing it in right at that moment, and since then we've rallied from it. But I do think the primary driver is Fed involvement. Now, the thing that's going on right now, I've been thinking about this sitting here all morning, and it is horrible as it is. Something to knock coronavirus off of the headlines. There is just this weird little minor positive about that. So on the other side of all this, the fear that had been instilled in the consumer might be lessened or forgotten a little bit. I know that's probably a strange take, but I believe it's in there somewhere.
Yeah, but hasn't the civil unrest, it's not affecting the markets? Because we were supposed to open on Wednesday, and now that's not going to happen. Not completely open, but at least get some people back to work and get people, pumping money into our economy. So the civil unrest is not affecting the markets, is what I'm asking.
The civil unrest is not affecting the stock market. Remember, the stock market is not a real reflection of the actual economy. You know what I mean? The stock market, that's what people, everybody's scratching their head over the last few months and saying, I've never seen such a disconnect between the stocks and the economy. And they're forgetting that they don't have to mirror each other. The stock market can show, one, it's forward thinking, and two, it's filtering in what I just said about the Fed, about the federal government, but not just those two things, too. Remember, the world's central banks are also throwing money into the system too, and all we have to do is be a better place to attract money than any other place, which is not a very high bar right now. So I think we're seeing that as well in our market. So again, it's not a reflection. It's not a fair comparison. Is this bad for the economy? Sure, it pushes out the recovery a little bit further.
Well, and something that I think people don't have a real appreciation for. You can be more profitable with fewer employees, so you can have a less optimistic employment picture and more profitable companies with better looking balance sheets. And that may be what you see happen, at least short term, coming out of this lockdown and burn down. My sense is that those 75% of people who think that their jobs are going to be there when the lockdown ends, about 2/3 of them are in for a surprise.
That could easily be the case too. And now, we're getting to a spot now where the PPE is running out PPP, the loans. So we might see a second wave of closures and some people being let go, and that obviously saddens me quite a bit. But the reality of it is that this is the recovery is going to come in two stages. The first one should be relatively gradual as people start to put their heads out of their homes saying that it's safe out here. And we've seen that at the restaurant openings that we've seen so far. But once it starts to gather steam, I think it could be quite fast, and I think that doesn't happen to the fall.
Yeah, and how is your restaurant Brandt's doing now that you've opened up the patio, correct?
We do. We have a lot of space at Brandt's. We were able to spread things out and put tables, and we're in a different situation than a lot of restaurants. We have unbelievable community support, and I'd love to thank people again for that. So from the moment we opened, essentially, we were, and crowded is the wrong word, because like I said, we have tables all over the place. We have places for people to space out, but there was a lot of people there, and people were glad to be out, it seemed like, and I think that only gathers steam. Now, the odd thing about our restaurant, too, is that we had switched to carryouts for the last few months. Carryout business is still booming. At the same time, we had a ton of eat-in diners as well.
But the landscape for restaurants and frankly, other leisure businesses is going to be markedly different as we start to look around, I suspect, in July and August.
Well, I think that there's no question of that at all. I think that restaurants, and you and I have talked about this before, I think it's safe to say that a quarter of the restaurants are probably going to go out of business. It's probably going to be more than that. I always like to be, conservative in my estimate, but I don't see how they're going to recover from this. It's a very difficult thing. Like we talk to our employees, and our employees are so glad to get back, and they are so understanding of the fact that we had to dig into our pockets over the last few months to support our business, and they're very, very appreciative of that. So we have a good thing going at our place, but I'm not sure other places do.
Now, just going back to the macro issue, you mentioned what Powell has said, the Fed chairman, about the tools he has in his toolbox, and he's got $7 trillion worth of liquidity and so on and so forth. But, that's still the vision for that was about 10 to 12 weeks of liquidity. So what happens if that's not enough? And one law professor, who's a former federal bank regulator at George Mason Law School, Tom Vartanian, argues that a financial revitalization fund should be stood up that could immediately act to invest in the preferred stock of large and small companies deemed vital to maintaining maximum levels of employment to help to advance the recovery and not so both in terms of liquidity and as well as employment. So you don't have states like Illinois with 21% unemployment at present looking at double-digit unemployment numbers for years potentially.
Here's the paradox with that, and I know other central banks and other government funds buy stocks, probably many of them U.S. companies as well, and we've actually started buying ETFs of municipal bonds and corporate bonds as well too. I think that on balance, it is a terrible, terrible idea. I think that when you get into the government being in the ownership on any level, it's just another step towards socialism. Today, it starts with just we're just going to buy a couple stocks from a couple companies,
Right.
and down the road, the government is sitting on boards of directors. So I think it's a terrible idea, and it's a terrible idea in a couple ways. One, from what I just mentioned. Two, it just disrupts the normal flow of the market. The zombie companies that haven't been able to meet debt loads over the last 10 years are being kept in business by rates being held organically low. Now the company comes in and starts buying bonds, essentially. I mean, the government does, and starts essentially lending money to these companies. They're supposed to. The cycle is supposed to be that companies that are underperforming go out of business, go into bankruptcy, whatever it is, and then reform stronger and better. And companies that are well run get stronger and better in the meantime. Anytime we start having the government come in interrupting that normal cycle, it is a flat out terrible thing, in my opinion.
So that's a good explanation of the downside of that proposal. What's the downside of running out of liquidity? I mean, even $7 trillion, if you're looking at an L-shaped recovery and you really have potentially, for example, the lockdown policies leading to a credit crunch in the financial sector. What's the downside there?
I think this is modern monetary theory. We started talking about it 6 or 7 years ago, and the notion was that the federal government could run deficits, potentially of $100 trillion for America if they're the ones who own the currency. So I think we're on that path. And what I think is that when you run out of liquidity, I don't think there's such thing. I think the Fed will continue to keep rates at zero, force them negative if they had to. Federal government will continue to spend, and the risk, which is enormous, that is not being talked about, is this cavalier attitude toward the currency. It's funny that we're talking about it today, because today the dollar has finally broke below the 9,800 level and seems to be heading lower. Nothing serious at all at this point as far as heading lower, but at some point in time it could. The biggest trade that I've been making and talking about on Twitter over the last couple of weeks is I have gold, but I also have silver, something that's going to be a proxy for fiat currencies, because that's the huge risk, is that we damage our currency, and they don't seem to count that as a risk right now, and I think they're desperately wrong.
Hey, Jim, when is it safe to look at our portfolio?
Right now, your portfolio looks good right now.
It's
just look at it today,
50%.
and then
I know, but it's not 100. I mean,
what do you want?
I'm hanging on every dollar and dime. I want to get out of this.
Hey, Jim, when do we have Dow 40,000 so Amy can leave?
Amy, maybe don't look at it at all. No, these prices now. I mean, the stocks have come screaming back from their lows. This is the feel good after you stop banging your head against the wall. Once it's rallied back 65-70% of what it lost when this thing whole started. So I am a longer term. Yeah, I know you want more, but I actually think. Okay, here's what I've been saying this week, and I still believe it. We've come a long way. And to go further from here and to go to those old highs, 3,400 in the S&P, I think we need some genuine, real, live economic data that shows that we're on recovery. That's clearly not here yet. So we got all this way on Fed intervention and on hope, but at some point in time, your hopes have to be confirmed, even to a small degree. So we have to see some good economic data. So right now, I am far, far less bullish on the short term than I was 3 weeks ago. And I've gotten out of some stuff and put on some short-term shorts. Longer term, I'm fine, because I think what happens eventually is that we get the virus is gone, the civil unrest is gone, but the Fed and the federal government probably won't be gone, at least not till it's a little bit too late, and this is how the bubble bust thing happens, but that's their tendency. So I think longer term, I'm fine with stocks, but in the short term, I think we've come a long way. I wish I could give you some better news in my mind, but that's what I think.
Well, so at what percentage do you put the risk of retracement right now?
Back to 2,800. We're at 3068 now, so back to 2,800, which looks, I'm just eyeballing it on my chart here, that looks like it's about 7-8%. I don't think we're going to cascade lower to the lows anymore. I think the worst parts are behind us.
All right, well that's somewhat optimistic. Amy that will have to do for
good.
Amy for now.
And then, can I make a reservation for 5 for Saturday at your place?
Sure, you can. Just text. We don't take reservations, and all my
you
regulars
don't?
who are listening going, wait, we don't take reservations.
Oh,
Just
all
for
right.
Amy, we're going to give one reservation.
That's fine.
Sure.
I don't want preferential treatment. I'll
Yeah,
just
stand
show
in line
up at
with
4
everybody
for the
else.
senior special.
Stand in line.
It's great. Waiting at Branch is the best part. We have these patios and Adirondack chairs. You can sit in the sun and have a drink. The waiting's the best part. You'll love it.
Oh,
Okay.
sounds like Bob Chin's,
I wanna
right?
go
Yeah,
now.
absolutely.
No doubt. Yeah.
All right.